Okay. All right. Well, it is 7:02, so we will get started, and should more join us, they will. I just want to welcome everybody to the Homebuyers webinar. The webinar is being brought to you thanks to our affiliate relationship with XSport Fitness. If you are not a member, or you don't know a member of XSport Fitness, don't worry. You'll benefit from the workshop as well, but you will not have, be able to take advantage of some of the exclusive benefits we offer the Export Fitness friends and family. I'm Jim Campanella, and I will be guiding you through tonight's workshop. The format of the webinar is going to be very open. So please, if you have any questions along the way, just type them in the question box, which is on your screen, and we'll make this interactive and educational. And with that, let me share the screen and we'll get this going for you here. There we should be going. Okay. All right. With that, we'll start here. For those of you who are here because of XSport's social media, or you picked up a flyer at one of the clubs, or met one of our staff members at the club, or any other means, this is the team we put together to help you become a homeowner. Besides being an amazingly good-looking group of people, we're here to help educate you. We're here to help you become a homeowner. Depending on which club you belong to, will help determine which one of us assists you, but you need not worry. Number one, we're all here to help. And number two, everyone in this picture has got the same desire to help you through the mortgage process. Again, I'm going to keep it light and formal, so it'd still be educational. So again, ask any questions along the way, and we can see how we can get you into owning a home. Okay, the basic agenda. We're just going to go over an overview of the whole process. There's so much, detail that we could go into that really the best scenario is we'll do an overview, and anything then at that point, we have questions on or anything like that, we can assist at that point. First thing we want to cover though is renting versus buying. In 2021, the average rent went up 13.5%. For some people, renting still makes perfect sense, but let's look at the differences between renting and buying. When you purchase a home, your property taxes and your mortgage interest become tax deductible. Assuming that this is the first time, your first home, that means you're either currently renting, living with family, friends. So it's somewhere that you feel safe. The real advantage of buying a home and why it's the American dream is because it's yours. There are plenty of statistics that show owning a home, your own home, creates a stability for your family and your children. Real estate is finite, meaning that there's just X amount of it on earth. So the values have always increased over time. It's a very good investment. Other than the Great Depression and the Great Recession of 2008, nationally, we've never seen home values drop. Sure, regionally, they may fluctuate, they may drop a little bit from time to time. In New England, they have, in California or in Texas. But overall, as a country, other than those two incidences, home ownership is always something that's a good investment. So across country, we want to present this idea of buying a home a little differently than just the numbers and everything else. There's more than just the financial side of it when you're looking at when you're buying a house. You look at the mental and the emotional side of it, which is the why. Are you trying to build equity? Are you trying to provide stability for your family? How long do you plan on staying in the house? Because that does make a difference when you take into account the closing costs and everything else. If you plan on moving every year, homeownership might not be the best choice. If you're looking to, build some roots, homeownership's a great choice. You know, and how much are you willing to put in? How much work are you willing to put into owning this home? Then there's the financial side of it. And this slide does a nice job in explaining everything, but I like to go to the basics because that's how I learned about the finance side of it. And the basics are the 4 C's. That's how lenders look at whether you're qualified to own a home. And 4 C's are capacity, capital, collateral, and credit. Capacity is what we would call your debt ratio, your income to your debts. Your capital is the income, or not the income, the asset you have to put into it, your down payment, the cash you have. Collateral, of course, is the house. You know, we need to determine the value of the house. And the credit is credit, your credit history and your ability to repay. So if you understand the 4 C's, you'll understand what the bank is looking at when they're trying to get you qualified for a loan. Now, everybody's interested in credit score. We can do an entire webinar on credit score. In fact, we do have entire webinars on credit. But give you the breakdown of how your credit score is determined. Credit scores are anywhere from, depending on which one it is, 350 to 900 or 850. But 35% of your score is based on your payment history. And I start there, one, because it's the largest percentage, but also it's the part that we cannot go in and quickly fix. Your payment history is your history. Now, certainly, you know, there's ways of tweaking credit and there's credit services that do such a thing, but your payment history is your history. So it's always important to make sure you're paying your bills. It's certainly important that you've been paying them the last year or two on time. If you do have current delinquencies, now may not be the time, you know, to be buying a house. If you were unable to make your car payment last month, certainly it's understandable. We're in the middle of COVID and everything else. But if you're not able to make your bill payments today, it's going to be hard to convince a lender that you're credit worthy today. So payment history is important. Beyond that, though, 30% of the credit score goes to amounts owed, which would be a breakdown of, let's say you have a credit card that has an available credit of $1,000. If you owe $1,000, you're going to have a lower score than if you owe $100. You have more ability if you've got more credit available to you. Length of credit, types of credit, and new credit all make up the difference. Now, if you look at this chart here, you notice that credit inquiries is not listed. Many people focus on, you know, they don't want their credit pulled because it may lower their score, which it could. But what you're missing is the fact that if we don't pull your credit, we can't really determine if you're credit qualified. So it's sort of a situation where you know, the worst of the two evils. One of the benefits, however, I'll explain in a bit, is the difference between a hard pull and a soft pull, and the advantage that cross-country can offer you with that. Okay, again, here's a breakdown of credit. Anything above 740 is, you know, excellent credit, and then it breaks down accordingly. Anything below 640 would be considered fair credit. Now, that does not mean you're not able to purchase a home. We have programs that go down substantially less than 640. There are 3 national credit bureaus in the country: TransUnion, Equifax, and Experian. Currently, each one has 16 different scoring methods. So that means there's 48 scoring methods out there. When you pull your consumer score, something, you know, you may do with a, you know, your credit cards or something like that, the score will differ than one we use, because we use a mortgage scoring system. If you were to go out and buy a car, they're going to have a different number because they use an auto scoring system. So even though you may look at your consumer score and say, my score is 800, 700, that isn't necessarily the score that a mortgage company is going to look at. And then keep in mind also, lenders look at the 4 C's. Credit is just one of the factors. So as an example, with mortgages, For FHA, our minimum score is 580 for the minimal down payment. You can actually go below 580 in certain situations, but 580 is the minimum down payment. Just because you have 580 does not necessarily mean that you'd be approved for a mortgage, because we look at all 4 factors. But it certainly, credit is a big part of that factor. Well, one of the questions that somebody's asked, which is an outstanding question when we're talking about credit, and again, the topic of credit would be can be an entire webinar, is that I do not have any established credit right now. Do I need credit cards? It's a long answer, but the simple answer is no. The simple answer is there are programs available through, as an example, with FHA, that we can use alternate credit to develop a credit report in effect for you. If you had credit cards, would it help? Yeah, probably. It give you a credit score and everything else. But just because you don't have any credit right now does not necessarily mean you can't own a house. You certainly can. If you're paying rent right now and you're paying your cell phone and you're paying utilities and everything else, we can use all of that and create a credit report for you. So therefore, you can become a homeowner. Here's a tip that we offer, is that 1 out of 5 Americans, or 20% of all credit reports, have errors. So you should be checking your credit report. Actually, what I want to, let's go back to that real quick. One of the bonus pieces that I provide everybody who attends the meeting is information on credit. And what that is just so you're aware, is again, you should be checking your credit report. Historically, you can check your credit report for free at annualcreditreport.com. It's a service offered by the federal government where all 3 credit bureaus, you go to that website and all 3 credit bureaus are there, and they will provide you your credit report for free. They don't give you your credit score for free. You have to pay a small fee for that, but your credit report you can get every year. Due to COVID, they've actually changed that, and you don't even have to do it annually. It now allows you to do it monthly. I'm sorry, weekly. You can actually pull your credit weekly. I don't know that you'd want to do that, but you can. But certainly you want to be at least pulling it annually. And again, it's annualcreditreport.com. Any of the other services like freecreditreport.com and stuff like that, they're actually paid services. Annualcreditreport.com is what the government has set up for you to access your credit report and see what information is there. If you find any errors on it right at that website, you can then dispute those items and get it corrected yourself. Okay, difference between hard pull and soft pull. A lot of people are aware of what the differences are, but real quickly, a hard pull credit is an inquiry. We do need to do a hard pull to give you a mortgage. If we extend you credit, or you apply to get credit extended, we have to pull your credit as a hard pull. However, through the pre-approval process, Cross Country Mortgage can do a soft pull, where therefore we do not actually cause an inquiry on your credit. So it's a great place to start with Cross Country, because we can see where you're at today without affecting your credit and help you prepare for homeownership. It's one of the features we offer, and it's certainly you would want to take advantage of that. Now, again, when I started, I had mentioned, we take a slightly different approach at Cross Country to qualifying you for a loan. Ultimately, the bottom line is we have the same guidelines as everybody else, but we don't just want to see you own a house. We want to see you successfully own a house. Everybody on this team has been around quite, for a while, and we want to see you succeed. So we include in our webinar this part of it, which is the monthly survival number. And again, this could be an entire workshop, and it is going over this, but it's how to budget. It's important that you even before you apply for a loan, understand your own budget, because then you would know, what numbers you can afford. I've had plenty of customers come back to me through the process and say, Jim, my rent's $1,100 a month. I'd like to have a mortgage payment of $1,100, keep my mortgage payment at $1,100. I may be able to get them qualified for $1,400 or $1,500, but their comfort level is 11. You need to know that number, because just because the bank says you're approved for a bigger number does not necessarily mean you want that bigger number. So monthly survival number, real quick. And again, I provide you, Cross Country will provide you the information, a breakdown of this for yourself. But you take a look at all your expenses, you take a look at your income every month, and whatever's left over is what you're able to set aside. Your survival number is what your expenses are. So your rent, your mortgage, your auto, your monthly payment on your student loans, all those type of items. Your goal, and this doesn't necessarily affect buying a home here, but your goal would be to have 6 months or even 12 months as your survival number. So if it costs you $1,500 a month to live, and at the end of the day you have $3,000 in the bank, you've got 2 months survival. The goal would be obviously to build that up to 6 months or 12. Many of our programs, lending programs, really don't look at this and doesn't look at what we consider reserves. So this budget here is really to help you understand your own situation more so than qualify. We need to verify you have sufficient funds to close, but not necessarily do we get into, if you have the reserves with it. Now, some of our programs do have that, but for the most part, this is really, again, to build your comfort. Okay, so going into the C's again, we're going to talk about, your ability to come up with your down payment. Conventional financing has a minimum of 3%. Government financing, which is FHA, would be 3.5%. VA is 0. USDA is 0 down payment. So technically, you can actually, if you're a vet, thank you for your service, and you can buy a house with no money down. And then we get into the loan amounts. I noticed this slide actually needs to be updated because the max loan amount is now above 548. So if you're looking to buy your first home above 548, we can help you with that too. And then again, your down payment, in the perfect world, you've saved it. If you haven't saved it, there's opportunities that you can get a gift from your parents or family member or something like that as well to make up that difference. A lot of confusion comes in where first-time home buyers say, well, I've got my I'm buying a $100,000 house, I've got $3,500 saved, I want to buy a house. And when you look at that, you have to take into account your down payment, but also your closing costs. It does cost money to purchase a home. It costs money to purchase real estate. There's, besides lender costs, there's title costs, there's transfer taxes, there's a variety of fees. Depending on the purchase price, it's anywhere from 2 to 5% additional above your down payment. Now, again, there's ways around that. There's no ways around the closing costs, but there's ways around you having it through either seller paying part of the closing costs or other means where one of our loan officers would be able to help you through that. But keep that in mind, that just because you have your 3.5% down payment does not necessarily mean that that will cover everything you need to purchase a home. Breaking into that, I find that this is where a lot of first-time buyers lose the excitement of buying a house, is when they realize the costs associated with buying the house beyond the down payment. Should you want a home inspection, it's going to be somewhere in that price range of say $250 to $1,000. Appraisal, you have no way around. Realistically, although it says $350 to $550, you're looking at $500 to $650 for the appraisal. Homeowners insurance, attorney not required in the state of Illinois, but we strongly recommend it. Lender fees, title fees, and transfer tax. So again, you're looking at something in the 2 to 5% range to cover that. Now, this is where, as an XSport Fitness member, our affiliate relationship with Cross Country is to your advantage. And we'll get into more detail on that, but cross country can help you with some of these closing costs. Okay, your income, 2020 was a rough year for a lot of people. COVID shut down the economy. A lot of people's incomes in 2020 ended up being less. Unless you have unemployment on a regular basis, such as being a landscaper or something like that, even though that made up part of your income in 2020, we can't count that. The good news is we're now in 2022, so you should be having, your W-2 should be out for 2021, and hopefully your income has recovered to the point where we can use your 2021 income. When we put together this presentation, we were still in 2021. That meant that we were using the 2020 income, and that affected a lot of people. So again, it's important to talk with your loan officer ahead of time so we can take a look at your income and determine what we can use for to qualify you. And this ties into your debt to income ratio, your DTI. These are rather extreme examples, although they are the correct examples. Again, if you're going with an FHA file, you can basically go up to 57% of your income. That does not mean if you're at 57%, you're going to get approved. What that means is if you're at 58%, you won't be approved. We look at the 4 C's, and when a lender looks at the 4 C's, this is one of them, that you can go up to 57%. Realistically, most lenders want to see around 45% total debt income. And what that means is your gross income divided by your expenses. So, if you make $1,000 a month gross income and your expenses are $450, including your house payment, that's 45% of $1,000. And, that'd be what we would use as your DTI. Your housing ratio would be just, the housing versus the total. Your housing would include your principal and interest, your taxes and insurance, and if you happen to be buying a condo, your condo association fee. Okay, another tip is keeping your debt to DTI lower, improves your ability to qualify. Again, this goes back to the story I used where I had a client that wanted to keep their payment, $1,000 or $1,100. Even though we felt their DTI could be higher than that, that was their comfort level. So by bringing down some of that debt, that helped them qualify. And that's where it's, again, important to be looking at getting yourself, pre-qualified, or at least talking to a lender, talking to us ahead of time, so that we can start putting a plan together. Because it's possible that, today your situation is this, but we could tweak it. We can maybe pay off some debt over the next month or two, take your tax refund, pay down some debt to help qualify you a little better. So being prepared for home ownership is very important. Okay, what makes up your monthly payment? Again, principal, interest, taxes, homeowners insurance, and if you have homeowners association dues. If you're putting on a conventional loan, if you're putting less than 20% down, or if you're going FHA, you'll also have mortgage insurance. FHA calls it mortgage insurance premium. Conventional calls it private mortgage insurance, but in both cases, it's insurance to the lender in case you don't make your payments. The insurance insures the lender, but you make the payment of that insurance built into your payment. Okay, so what exactly is the process or the roadmap you need to go through when you're trying to purchase a home? It's important to know who's going to be on your team. And the order of this is pretty accurate. You want to start with your loan officer. You want to get a hold of your cross-country loan officer and say, hey, let's talk about, me buying a house. In the old days, you might have started with your real estate agent, but today, with the tight market and the technologies that are out there, all real estate agents want you to first get yourself pre-approved, or at least first talk with a loan officer. So we are your first step. After that, you want to find a real estate agent that you like, that you feel comfortable with. There are very well qualified realtors out there. If you don't know one, certainly we can refer you on, family and friends, so on and so forth. Appraisal, he's going to be part of your team. You don't necessarily meet with him or anything like that, but he's going to determine the value of the house you're purchasing. Your attorney, again, not necessarily required in the state of Illinois. Strongly recommended. It's a very small investment for the largest purchase you're going to make, but not necessarily required. But you want to make sure that you have an attorney that's on your side. Title company, the seller provides in the state of Illinois, but they're going to be part of the process. They're going to bring down the title. They're going to make sure it's clean so that when at the closing, you end up owning the house. Home inspector, not required by any means, highly recommended to make sure that your house is what you're anticipating. And then the homeowner's insurance agent is, of course, you have to insure the house. So you want to be working with an agent that you feel comfortable with. All right, so the first thing you want to do, and this slide is a nice slide. It's a wonderful, in the perfect world example. And it says basically you want to meet 6 months to a year out before you intend on buying a house. And if you've got 6 months to a year, we should meet that time frame. However, in today's market and everything else, people aren't taking 6 to 12 months to meet with their loan officer. If you want to buy a house in 30, 60 days, meet with us now. You got to get in. The real point of what it is meeting with your lender is to take a look at your situation today, determine if you're qualified today, and if you're not, how we can get you to where you need to be so that you do qualify. So before you start looking at houses and everything else, you want to meet with your loan officer. I say this all the time, but knowledge is power. So let's take a look at where you're at so that we know where you want to be in the future. Okay, the difference between pre-qualifying and pre-approval. You may have heard of both, out there as just things you hear. Pre-qualifying basically is you sit down and say, hey, this is my situation, here's my income, so on and so forth. They work up the numbers for you and, say, hey, you're pre-qualified to X. It's a tool. It's not a very good tool, but it's a tool. Your better choice is to get pre-approved. And again, this is where you're working with your cross-country loan officer. If you get yourself pre-approved, we're going to verify some information. We're going to ask you for your tax returns, your W-2s, your pay stubs. We're going to pull credit. We're going to get you an actual pre-approval so that you know what your buying power is when it comes time to buy a house. And then it helps your realtor price houses accordingly. The benefits to a pre-approval, again, is helps determine your budget. You don't want to be falling in love with $300,000 homes if the lender is going to approve you for $200,000. It gives you greater buying power because you're pre-approved. You can make an offer on a contract saying, hey, I'd like to buy your house, and by the way, I'm already pre-approved. So it gives you a little leg up. It helps avoid setbacks, and I think this is a big one, especially post-COVID, is, should there have been some obstacles in the past, a delinquency or some collections or a dip in your income, we can address all that before you go through the process of buying a home. Buying a home is a very stressful process. You're making the biggest purchase of your life. If we can alleviate some of that stress for you ahead of time, it just makes sense to do that. Basic information that we're going to need: pay stubs, tax returns, verification of your assets, a photo ID, and then of course we verify your credit. After that, again, keeping in mind that we're on this roadmap, after you're pre-approved, you find a home. In the perfect world, again, this makes perfect sense that you can be doing it along these time frames. We're not necessarily in a perfect world. You may be aware, if you watch the news and everything, there happens to be an inventory shortage. There's more buyers than there are properties available. So this part of it of finding a home may take a little while. You just should be prepared for that. And again, working with the right realtor will help you prepare for that. You may have to make more than one offer before you actually go under contract. Right now, that's a normal thing. So that shouldn't, shouldn't get you frustrated or anything like that. That's just the process we're in right now. It may take 3 months. You might, luck out and buy a house immediately. It may take up to a year. But it's best that you get yourself pre-approved so you know what your buying power is, and then work with the realtor to get you in the right neighborhood, the property tax, and everything that you're looking at. Okay, once you're under contract, congratulations, you're buying a house. You officially apply for the mortgage. Even though you've been pre-approved, you have not applied for the mortgage because you have to have a contract as one of the 6 items for a mortgage. The do's and don'ts, again, if you're interested, I can provide you an entire packet of information on your do's and don'ts. Life doesn't end when you apply for a mortgage, even though we would like it that it would. We would prefer that you did not do a lot of things, and we strongly recommend you don't do a lot of things, but we recognize life goes on. But any changes of your employment, communicate that to us, or don't quit your job during the process. Continue to pay your rent, because we have to continue to show that you have good credit. If you have to transfer money between accounts, document everything. Those type of things. The things you don't quit your job. Or if you are, if you have to quit your job, or you transfer to another job, inform us that this is what you're doing, so we can make sure that your new job, the income qualifies. Don't co-sign for anybody, because if you co-sign for somebody, we have to count that debt against you, even though you're just a co-signer. It's still your debt. Don't open or close any credit cards, unless, again, we talk about this. Don't go out and buy a $100,000 car unless that was, discussed, so we are aware of all that. Again, all this information is available that we provide in a packet that's, to help put it in front of you. So once we gather everything, your file then goes to underwriting. That's after the appraisal is done. And the underwriter will go through everything, check the documentation, make sure you're qualified. May have a question or two, that's common. And then you go to closing. And once you're at closing, you sign a lot of paperwork, and you leave the closing with the keys to your new house. A lot of people ask the difference between a home inspection and a home appraisal. A home inspection is determining the condition of the property. Not required by the lender by any means. Highly recommended again, but it's not required. It's really for your own sake. Whereas an appraisal is required. The lender will order the appraisal, and we're determining the value of the house, not necessarily the condition. So that's where you may want to have a home inspection who's going to go more into making sure the electric, is up to code and everything else. The appraiser is going to determine the value of the house. And here's just a simple breakdown of some of the definitions of what it is. Transfer taxes is a tax the state of Illinois assesses, or the county assesses. Recording fees are to record the mortgage. But this is a nice little breakdown of definitions. Okay, so we've talked about closing costs. Again, we've got lender fees, title charges, transfer taxes, everything like that. This is the exciting thing. As a member of XSport, or a family member, somebody who is a member of XSport, through our affiliate relationship with Cross Country, we're able to save you $2,198 in closing costs. Now that's real money we're saving you. It's $2,198. So again, when we talked about you need your down payment plus closing costs, because you're a member of XSport, through using Cross Country as your lender, you're going to save $2,198 out of your pocket. Though costs really exist, Cross Country is absorbing them. They're paying it on your behalf. So you are, it's that much less money you need to close. Okay. So any questions you have about that, again, your loan officer can assist you with that. If you are currently not a member of XSport, unfortunately, this deal is not available. My suggestion is there's plenty of XSports around. Choose a location and join XSport, and then we'd be able to offer you this benefit as well. All right. So I believe that there's been a lot of conversation all of a sudden recently in the news about rates going up. There should be some actually more today conversation about it. So welcome to 2022. Help you understanding where rates are. If you can understand the graph here, since 1985 when I started writing loans, other than a couple times, rates have really been falling for the last X amount of years. And, in general, 2022 is probably going to see a change to that. Rates have begun rising, at least from the all-time lows of 2021. That should not put a hamper on you deciding to purchase a home. You're going to hear a lot about rates going up this year. They are going up this year. But that doesn't mean buying a home is not a good idea. It's actually a great idea. You may want to do it sooner than later because rates are going to continue to rise. But you definitely, if home ownership is something that's that's your family wants and desires, you should be doing this. The fact rates are rising shouldn't matter. From 1971, just a little statistics for you guys, from 1971 to 2020, annualized, so each year, the average rate was 7.89 for mortgages. We're well under that right now. We are not at the all-time lows anymore. But rates are still absolutely fantastic. 7.89 is the last 30-year average. We're well under that. In 1981, just as an example, one specific year, the average for the year mortgage rate for a 30-year loan was 16.63. We're nowhere near that. In 2008, which was the Great Recession, when the housing bubble hit, rates were 6.03 average. We're well under that. Even if they continue to rise the rest of the year, we're probably going to stay under 6%. So don't let people run around scaring you that, rates are rising and things are bad. You're just not going to get the all-time lowest rate right now. That's not going to happen. But you still are going to end up with a great rate. Now, with that said, taking a look at the graph in purple, if you're ready to buy a house, you should be considering it sooner than later, because if the experts are correct that rates will continue to rise this year, your buying power will be reduced. Here's your example. You can see that your buying power keeps going down as the rates go up. It's basically, in this example, you go from $250,000 buying power down to $242,000, so you lose $8,000 buying power. So meeting with your loan officer, if you're ready to if this is something you're considering, you should meet with your loan officer sooner. It may take 3 to 6 months to get you into a house. It may take 3 to 6 months to get you qualified. You should be doing that sooner than later, but keep in mind, don't let the fact that rates are rising stop you from being that homeowner. Okay, if we have any other, that's a quick recap of the presentation. If we have any other questions, certainly, let's pose them in the questions and answers. Again, here's the team. We're all here to assist you. And, we can take some questions and answers now. And then finally, should you wish to get some additional information as a thank you, we do have, if you'd like to, reach out to Erica, that's her contact information. We do have a free gift for you, as well as some bonus material that we'll be happy to mail out to you for free. In order to mail it out to you, we actually need to know your name, mailing address, and so on, so that we can provide that information to you. But included in the free information is how to prepare a budget, the do's and don'ts of homeownership, and so on and so forth. But again, if you just reach out to Erica, we can get that out to you right away. And if we have any other questions, be happy to answer them at this point. There we go. And if we don't have any questions, which we're not having any come in, then I again want to thank you for attending today's workshop. I want to thank you for being an XSport Fitness member, as well as allowing Cross Country the opportunity to present this to you. And I look forward to talking with you guys soon.